If you are a two-legged individual, you are always paying feeder fund fees, and they charge 1% on every single feeder fund on the committed amount. That is an egregious fee. Number one reason you want to avoid draw structures is because they're... So why evergreen funds? Why do we like them? Good afternoon. It's Patrick Dwyer and Greg Pool, and we are here in freezing Miami to give you a little chat about private equity and why we continue to like evergreen structures more than most draw structures. And let's talk about why.
Yeah. So, I mean, as we repeat frequently, our mantra is for things that we think are beta, keep it simple, keep it low cost, and reserve your fees and your complexity for things that are really different. Where we're saying we're beta, it would just be exposure to a market. So, in the equity market, beta would be, the index, the S&P 500 or the MSCI World. In private equity, it would be something that's big enough that it's really going to just perform in line with the PE industry, where it's really difficult to outperform. So there's no what we would call.
So in other words, when we say beta, we mean this is going to do average. If you're going to get average, you should be focused on structure and fees.
Average doesn't mean bad. Like average could be good. If it's a market they don't like, average is good.
Private equity beta is really good. And you're probably getting a return of like 9 to 11%. It's like great, right?
That's right.
Alpha would be over 14%. Yeah. That's like, you think your returns are going to be exceptionally high. That's what it would be. So that's how we sort of talk about these things. So most people in PE, they're not LPs. They think so if you look at most literature, it'll say you're better off investing in a draw fund. You're always better off investing. That's true if you're not paying any feeder fund fees. And that is not, if you are a two-legged individual, you are always paying feeder fund fees. You are not going direct, right? So you're paying 2 and 20 plus the feeder fund structure, which is as high as 1%. We were just looking at one of our competitors in San Francisco, and they charge 1% on every single feeder fund on the committed amount. That is an egregious fee. It means that essentially, even if the manager does get over the magical 14.5%, that you've given most of that alpha to the manager. You've given it to the advisor who sold it to you because you're paying 100 basis points uncommitted. So that is why, that is the number one reason you want to avoid draw structures, is because they're laden with upfronts and all these spin drag that are tacked on to the 2 and 20.
Most people don't even know what all those fees are. I mean, we can run through. You've got, oftentimes you've got an underlying management fee, which would be kind of 1.5% to 2%, and that could be on committed capital. The underlying carry, which assuming they perform well, could be 2 to 3%. There's a hurdle, but there's a catch up. So they're really getting money from really $1. Yeah. There's a feeder fund fee, which could be, up to 50, up to 100 basis points in some cases. There's admin legal expenses. You're getting a much more complicated tax. So you're added to your tax bill. And then you can have multi-state filings. So these are all fees that add up to hit your return.
Yeah. In fact, I'm paying a multi-state filing on a 15-year-old private equity fund I have that there's $20,000 left in, and I have to file a tax return in 3 states. So you can imagine I'm not happy about that. So why evergreen funds? Why do we like them? They have a lower fee drag. So they start off, typically they're 1.25% and 12.5% carried. So that's compared to 2 and 20 plus feeder fund fees, right? So you get your tax return comes on time, theoretically. Okay. So you're not going to be waiting till October for your tax return. It's supposed to come before April 15th, which would be a miracle, but that is what is happening. So that's the first little convenience thing. Our typical client has between 15 and 50 or 60 private investments, which we capture there. The feeder fund itself, if you buy the institutional share class, does not have all these other tack-on fees as well with it. And in some cases, there are discounts, and you're getting a report every 30 days of what the valuation is, which is also really nice. You actually know how your investment is doing that year. Basically, the numbers come down to, like, we could talk about this for 6 days, but it's just, if you think the private equity fund or the venture fund can do over 14.5% gross of fees, right? Gross of fees, you should buy a draw fund. If you don't, you should probably stick to the evergreen structure and enjoy having some liquidity, being able to rebalance your portfolio, lower fee structure, and being fully invested day one. It's literally that simple. And so that's going to reduce the amount of deals you're going to buy a lot. It's just going to make whoever is selling you these marked up things very unhappy, but it is in your best interest.
And, the punchline is after tax, Drawdown's edge is really tiny for most people on a return basis. And obviously there is the added complexity. What we've found is the after tax difference is 0.8% when you actually run the math on fees. And then, that's the real world tax and admin burden is additional to that. So it cuts into that. But, people say the drawdown fund always wins. That story really shrinks. The traditional PE drawdown via feeder fund is about 7.6%. The Evergreen fund after tax is about 6.8%. That gets you to the 80 basis points. So, that's a pretty small difference, especially when you add on the additional complexity and the other fees.
Yeah. I mean, I think so. In other words, big funds. So if we're buying KKR, we're going to buy a feeder fund, right? Big funds all have these evergreen structures. Small funds, we're going to do a draw fund. So if we're buying a deep tech shop playground, we're going to do their draw fund. It's the only way to access that, right? If we're going to access Apollo, we'll be doing it through their evergreen structure.
Yeah.
And that is, the best way to invest, whether you have, $20 million or $5 billion. These things are true in both situations.
Yeah. I mean, you just were touting what are the stats of how many, what percentage of institutions and endowments are now using Evergreen funds.
Yeah, well, this is really interesting, and it just shows you that we were right 2 years ago when we said this to clients. And by the way, the performance of the Evergreen structures has been excellent in the marketplace, better than the privates. But we sat down with the second largest private equity shop in the world, and they told us 85% of all their ultra high net worth sales now are Evergreen structures. 85% ultra high net worth, so that's over 25 billion. And 15% of all their institutional sales now are. So institutions that are only $1 billion to $3 billion are buying Evergreen structures. You know why? Because it's a smarter structure. And my view is that in 2 or 3 years, it'll be 50% of institutional investors will go that way.
It seems like it's heading that way.
It does.
So basically, look, what's our framework then? It's use drawdown only where the premium is worth it. So choose your Evergreen for your big funds, big allocations, your core private equity, core infrastructure, core real estate. And then keep your drawdown for what we would call, your high dispersion hunting grounds. That's maybe venture capital, small or mid-market buyouts, maybe small real estate, and maybe a private credit fund where you really can get some advantageous pricing. Really try to keep those separate and be, I'd say, discerning about where you're using drawdown.
Yes. And if you are a wealthy individual and you have an account at a big broker dealer or one of our competitors, take your private investments, put them into ChatGPT and ask it, what fees did I pay for this? You're going to be shocked and you're going to fire your advisor when you find this out. Find that your advisor has been getting most of the economics out of this, not you. So do that. Give us a call. We'll walk you through what you're paying, what you should be paying, and what's in your best interest.
Yeah, but remember, Aligned is about the best outcomes, not the most FOMO candidates.
That's right. And please like and subscribe to Aligned on YouTube. Thank you.